What's up, you guys, and welcome back to the channel where today we're going to be talking about beta. Sure, there's plenty of risky stocks out there that you can generate returns way higher than the S&P 500, but at what cost? The old sayings, the more risk, the more reward, and that is absolutely true. Some of these stocks, if the S&P 500 were to go up, 10%, these stocks might go up 20. But on the flip side, if the S&P 500 were to go down 10%, these stocks might go down 20. So it really just comes down to the risk you're willing to take in order to beat the actual market. So in this video, we're going to be going over beta, which is the measurement of risk within a stock compared to the S&P 500 usually. That way you can tell, how much risk are you taking on for this, and can you generate an excess return for that given risk, or what we'll call alpha, and talk about in our next video. So beta is, at a basic sense, the correlation of a stock to the S&P 500, or really any other asset class. If you wanted to use a different asset class, you could check out our beta in Excel video. That way you could go ahead and make that for a different asset class. But typically speaking, the beta that you see online is going to be against the S&P 500 5-year. And it's basically a measurement of the correlation. So if a stock has a beta of exactly 1, then if the S&P 500 goes up 1%, this stock went up 1%. If the S&P 500 went up 2%, this stock went up 2%. A beta of 2, for example, if the S&P 500 went up 1%, then this stock typically went up 2%. So it would be twice as risky as the S&P 500. And the same goes for down moves. So if the S&P 500 went down 1%, this stock would go down 2%. Now, there's also negative betas out there, which means the stock is generally speaking going to be negatively correlated to the S&P 500, meaning it typically does well when the S&P 500 does bad. This is fairly rare. I know Tesla at one point did actually have a negative beta, but it was primarily due to the massive returns Tesla was having while the stock market was fairly stagnant. Now, you do have to think about the fact that the beta is calculated based on past performance. So even if a stock today had a beta of 1, so it was exactly correlated to the S&P 500, if things were to change today and the stock were to go up 2% and the S&P 500 only went up 1%, then all of a sudden the stock's beta might change to a 1.01, for example, or whatever the math behind that would be. Not exactly relevant or important at the moment, but it would change right now. So you do have to consider the fact that, like most things in the stock market, all the calculations are based on past performance and are no indication of future performance. But this is really important to keep in mind when building a portfolio and tracking a portfolio, because it's really easy to go buy a bunch of risky stocks and outpace the market by 20% and think, hey, I beat the market, I'm really good at this. The fact is, you may have taken 3 times, 4 times more risk in order to achieve that 20% return compared to maybe a 10 in the broad-based markets. So you didn't exactly do anything special. Something special would be taking on 5% more risk and doubling your returns, or taking on, slightly less risk and getting the exact same return. That's going to be called alpha. We're going to go over that in a more in-depth video, but that's why the website Seeking Alpha is called Seeking Alpha. Everyone is seeking to produce an alpha, a positive return given the risk taken. So that is going to be beta. It's pretty simple. If you guys are interested in learning exactly how beta works, the calculations behind it, that way you can use it against another asset class. Maybe you want to use the S&P 500. Maybe instead of that, you want to use the NASDAQ, or you want to use the Dow, or you want to compare 2 stocks together and just get their correlation. You guys can check out our beta in Excel video. That will be on the channel, as well as linked in the description. And before I let you guys go, I wanted to tell you a little bit about Acorns. Acorns is an investing app that will invest for you for the low cost of $1 per month, unless you go with a higher plan or something. But this is essentially where you can easily invest and not have to do a lot of work. And it'll also round up your change off of credit card and debit card purchases within your bank account and invest those pretty seamlessly, so it doesn't feel like it's taking a lot of money from you. It makes investing simple, especially if you're not very good at saving money. So I'm going to leave a link in the description there. If you use that and sign up and make a first deposit, you'll get $5 completely for free. Shouldn't take you more than 5 to 10 minutes to do so, so pretty good value there. And with that being said, if you guys did enjoy this video, be sure to give it a big thumbs up. If you guys are new to the channel, consider clicking that subscribe button. And with all that being said, I will catch you guys next time. Peace.